And you can have fully collateralized. What does that mean? That for every token, there's a pound. For every pound token, there is a pound. It's usually in a bank account or a trust or a custodian somewhere, but it's fully verifiable that it's what we call assets exceed liabilities. There's more than enough pounds in the bank to cover all the tokens out there, not printing extra tokens. Okay. Then there's somewhat collateralized, which might be a basket of money, cryptocurrencies, hard assets, any number of things, and that forms the collateral. And there could be, say, half of the value could be collateral, and half the value could be more or less what we call monetary policy. So that that's like a fractional reserve system where you have some value, but you kind of print more, and everybody understands that. And then you can have a completely uncollateralized system that has nothing. It's just we made it up, and we say it's worth $1, and if enough people buy it and sell it and it stays worth $1, then it's worth $1 until it crashes, but that might not happen for a long time, so maybe it'll work. It's what we call a Ponzi Nakamoto scheme. And there's several Nakamoto Ponzi scheme. There are several. You might have heard of DAI, which I spoke about last time. Did anybody remember this conversation where some guys came to me and say, DAI is really good, you're mischaracterizing it? Remember that? And so on further inspection, and I said there's some sort of dumb things, there's some dumb ideas out there. If I can just bring this up here. Okay, I'll take it. So there's some dumb ideas, and one of the ideas that the guys came up to me and said, look, so there's Maker, and there's DAI, right? And the DAI is the stable coin. And if we look up the price of DAI, and I have it here. Here's the price of DAI. Okay, it's pretty stable, aside from a few moments of sheer terror, after which it managed to recover. And this is up as of a few months ago. It's pretty stable. But this is the Maker token, which is essentially kind of you think of it as the equity in the project. These are the guys who are taking the other side of the trade, betting on the volatility, and they're hoping to make money. These are speculators, and the price of Maker has gone down, down, down. And then I said that, and this guy said, no, the price of Maker has gone up, up, up. See, this is Maker right here. It's gone like that. I said, relative to what? Well, he says, relative to ETH. Maker. So yeah, Maker hasn't lost as much value as Ether has. Okay, so if you lived in a world of Ether where you pay your rent in Ether, you buy your groceries in Ether, and you get loans in Ether, then Maker has done very well, and you're glad you switched out of Ether into Maker. On the other hand, if you turn this the other way, it really looks like this. It has gone down a bit less. But remember, you're on the other side of a trade. The other side of the trade is DAI, right? DAI has done fantastically against Ether. Ether's gone down 80%, and DAI has gone down nothing. So if at the same time you bought your Maker, you had instead been on the other side of the trade and bought the DAI, it would have looked like this. You'd be in much, much better shape, right? But we don't live in a world of Ether, so this is a false way to look at it. We all have some Ether, but mostly we live in a world of pounds or some kind of fiat currency. So these Nakamoto Ponzi schemes, which is essentially what we call synthetic stablecoins, have a risk. And those who have the coin have risk, and those who take off the risk and hope to make some money on it also have risk. Why? Because it's just made up, right? Now you could say, well, sorry, but the dollar is made up, and the pound is just made up. And that's the subject of another event that Rupert is going to put on, where I will explain what money is, which will probably shock most of you. But assuming that the pound is a reasonable product and the dollar is a reasonable product, and we live our lives in it and we pay our rent in it, then these synthetic coins are not particularly, well, they have risk. They might be stable, but they might be terrifyingly stable. Right? So most of us, and in fact there was a project called Basis whose goal was to offer a better version of that, and they folded because they couldn't figure out how to do it. They just said, no, that's not going to work. So this is one called Tether, and you may have heard of Tether. Tether is an Ether-based dollar, and it's done really well. I mean, empirically, you got to say that it's pretty damn stable. And if you had had this instead of Ether, a year ago, if you'd sold your Ether and bought this thing a year ago, you would have turned out really well. There's a bunch of sketchiness and weirdness around Tether, but generally, the general belief from people I've spoken to is that assets exceed liabilities, that the collateral is there. So there is, what is it, it's several billion dollars, $3 billion or $2 billion worth of Tether right now, that there is $2 billion in the bank account. They just don't show it very well. They're not very good about auditing, but that it's there. So there's some risk there. The risk is that, well, what are they doing with the collateral? Well, the understanding is mostly that it's there, and that it's also interesting because you can't redeem it. Now you say, oh, you can't redeem it. What? I can't get my dollars back. If I send them dollars and they make some Tether for me, I can't reverse that? No, you can't. And what makes that interesting is that it's not money. It's not seen as money now. And the authorities don't see it as money, and so we can move without money licenses. It's actually very clever. The sketchiness of this product makes it very useful in our world of wallets and frictionless peer-to-peer moving. It's real money, but it's not governed as money, and it's not, you don't have to do AML. You don't have to have licenses. You don't need a banking license. It's this quasi thing that I have to say until now works pretty well. So my belief about stable coins is that we want fully collateralized stable coins. You want to have assets exceed liabilities. There are going to be lots of these. Circle just announced one that's called USDC, and it's going nice and stable. I think it's a complete disaster, and it will just melt down and wash away within the next few years because they've made some mistakes, but there will be plenty more of these. And ultimately, we will have pounds, euros, and dollars in our wallets. Unfortunately, for the most part, we will have to have licenses to do that. So when they say, well, we're going to charge you, 2% or 3% to change into these things, you're going to say, what's up with that? Why so much? Could cover all our licensing and AML and all these services we have to provide to comply with the laws. Now, the U.S. Congress has just introduced 6 weeks ago a proposal for a law that says if the system doesn't take custody of the token that represents a dollar, then it's not a dollar and there'll be no licenses needed. In other words, if it's person to person and I have my private key and I send Rob some dollars and he has his private key and the system never has custody at any time of that, if it's true P2P, even though there may be price discovery and trading and speculating or whatever it might be used for, if the transfer is P2P with no custody in the middle, then no banking requirement, no license requirement, no e-money license, which is a big deal in the United States. If the day that law passes, a lot of things will change in the United States. Yeah?
Yeah, sorry to interrupt. Is this going to refer quickly to decentralized exchanges, to DAX? So because of the DAX, the decentralized exchange.
Well, the DAX is a good example, but there are also exchanges where you do price discovery on the exchange, but the swap is atomic from person to person, and they don't take custody.
Yeah.
So it could be centralized or decentralized, doesn't matter. What matters is that the swap is atomic, that they don't take custody, right? And you can even imagine a group like Shapeshift where they take custody for a second and then give it back. Just for a second they have custody. That might be exempt. If that happens, that will change our game because that will let us do a lot more things with stable tokens, stable coins with no licenses. That replicates around the world, and then that changes money. So the money is, where is it? It's sitting in a bank account, fine. But when it moves, no license. Very exciting. Okay, so that's just a quick spiel on, just an overview of stable coins. I want to keep moving, but does anybody have a question about stable coins?
Is no license necessarily a good thing? Because I mean, the ICO craze was a good thing in theory, apart from people proving they can't act ethically. So having unlicensed.
So the rest of the world outside of tokens is completely ethical and everything is straightforward, and nobody ever loses money outside of the token world?
I think there is logic in why the securities industry is regulated to prevent people getting ripped off. And the ICO.
That's your opinion. You're welcome to
in
it.
its purest sense was a great idea. We got lots of people investing in funding projects that they thought they found interesting. But it brought lots of unethical acts out of the woodwork, and people ended up.
Two things happened. First, it brought lots of unethical actors out of the woodwork. There are unethical actors anytime something new shows up in gambling, in marijuana stocks, in anything that's trendy and cool will have a lot of unethical actors. It's hard to say how many, because it's easy to sweep them all into the same bin and say, oh, they're all bad, and that's not really true. The Chinese government killed many very viable, some even important projects by sweeping them all away and saying they're all scams. They weren't. It's possible 80% were, it's possible 90, but it might be at 60, I don't know, but that doesn't mean that they were all bad. There are plenty of ways to lose your money to things that are horrible investments without being scams that are fully regulated. It's not hard to lose lose all your investment money in the regulated markets. I don't think, in my opinion, that regulators actually protect investors at all. I think it's a game. It's mostly used for advancing their own political careers. I don't think there's much evidence that financial regulations actually help investors. And the whole investing market is so much different now than it was even 20 years ago, that there's no more sort of home investors reading stock tables and cherry pickings. That doesn't exist anymore. So that world doesn't exist. So the whole regulating thing, I think, hasn't kept up and isn't based on evidence. It's mostly helpful to politicians to look tough and get elected. That's certainly the case with AML. AML has been shown conclusively to be ineffective, almost 100% ineffective. AML adds no value and sucks a lot of resources out of our economy and makes it difficult for innovation. So it's great for entrenched companies that have lots of AML capabilities, and startups can't make it because they can't do they can't go through the compliance. So it's really hard on it. It reduces innovation. The other part of your question was?
I suppose de-licensing the movement of money.
Oh,
sort of what you're talking about.
So some were scams, some were legitimate. What actually crushed the ICOs was one guy saying, I don't think these things are, I think anybody selling these things is violating security laws. And so if you think about it, what Jay Clayton is saying, the chairman of the SEC, is saying, I think this might be dangerous for a consumer, for investors. I think this might be a dangerous product. We're going to need to regulate it to make it safe. And that statement made investors lose all their money. He caused the losses by self-fulfilling prophecy. Many of them were very viable projects, but because they were only raised 5 to 10 million, they weren't able to continue when the price went, when their price went down by 60, 70, 80%. And so he single-handedly made them dangerous just by saying they looked dangerous, even when most of them weren't beforehand. So that was fun. We have to dig out of that ash heap. And we're doing it by doing these various types of tokens that at least look and smell compliant. And these stable coins today are seen as money if it's fully collateralized. They could be collateralized by any number of assets. But we hope later that if we have atomic swaps and they won't be regulated, that will unleash a lot of creativity and a lot of cool innovation without making anybody dangerous. Because even Tether, which is totally sketchy and no one really knows exactly what's under all the shells, works. And has helped a lot of people. A lot of people went into Tether in the last, a year ago and so forth, and saved themselves from a lot of difficulty. And just cashing out to a bank, we all know, can be very, very difficult. Cashing from crypto to a bank, banks are scared. Banks don't know what to do. Banks a lot of times won't take the money because of AML. Well, where's that been? What's the source of your funds? Doesn't smell very good to me. And so right now, and this is true, some Bitcoins are worth more than others. Well, how could that be? Because when you go to cash them and you send that money to a bank, they ask for the source of funds. If they have been to Caracas, they are more sketchy and worth less than if they've just been newly minted. Here in the UK, that's worth more. They actually have different market prices. There's a whole spectrum of price based on the provenance of a token because of a law that makes no sense. And that's too bad, because that's also happening to most of the tokens. Anything you want to cash out has this gray spectrum from sketchy to somehow looks fine and smells good to the AML people, and that's really sad. That's not the world that we wanted to create, and that's the world we unfortunately have to live in.
David, is it
Yes.
any chance you could talk about uncollateralized?
The Ponzi Nakamoto schemes? Well, I did already. I did uncollateralized as Maker and Basis, which died.
No, I know, but the future where we have ones that actually work properly.
I don't see it.
Okay.
Yeah, I don't see it. I wouldn't do it. We've talked about using DAI in our system, and people say, well, everybody likes it, it's trendy, and everybody's using it. And I say, okay, but it has a chance to blow up and crater and leave a smoking hole. It really does. The people investing in Maker are all of a sudden going to get this message that they're losing money and stop doing it. And if there is any kind of panic, or I have a slide here for this, uncertainty, then when the market cap goes down enough, it turns into a falling knife that no one wants to catch. And that really could happen with any uncollateralized stablecoin. In fact, there's some smart people I know with a group called Reserve. They got some money to build a stablecoin, and they looked at all the different possible ways to make a stablecoin. And the truth about stablecoins, in my view, and I could talk about the Soros coin, which would be fully uncollateralized. I will if we have time later. But they looked at everything and they said, no, it's got to be 100% collateralized at the beginning. And in stablecoins, the rule is the first billion is always the hardest. Really true. You can't do this without scale. You got 10, 20, $30 million of stablecoin. It doesn't matter if you're collateralized or not. Nobody has enough confidence in that this is going to last. So you've got to blast through that. And once you get to $1 billion, you can start doing more that you can't do at a lower scale. And I'll talk about the George Soros coin later if anybody wants, but which is a really interesting idea, but it takes billions of dollars to launch. Let me go back though, and kind of cover a couple other things. So yeah, now I will do skin in the game coins, but first let me do the non-fungibles because that's just fun. Non-fungible. Who knows what a non-fungible token is? Anybody know what non-fungibles? ERC 721.
Yeah. Unique.
Okay, but just sort of familiarity with ERC 721. Anybody here? A couple people. All right, so that's pretty. So few people. So what does non-fungible mean? It turns out to be a really important word. And the first thing you think of is, well, it's unique. It represents, a work of art or some given picture or your pair of socks that are different from the other pairs of socks. But it turns out that unique is a bad word, and I'll just show that right here. So these things, there's some scarcity around these things. These things are not lying on every street corner. The scarcity is what makes them valuable. And are these unique?
They have identity numbers which are different.
They're unique.
They are unique.
Are they fungible?
They are.
They're completely fungible, right? I don't care which one, right? Are kids fungible? No. Are apartments fungible? Are apartments fungible?
Sometimes.
In a large building where you have 20 apartments facing one way, what's the difference between the guy and his neighbor's apartments? It's the same layout, or So there's a very blurry continuum from completely unfungible, which is this, no one cares, to, because you could even have, you could say, well, bottles of wine are fungible if it's the same year, but well, how's it been kept? Or this was a present to me from my auntie who passed away, or whatever. So you can have different levels of fungibility just for different people for the same exact thing.
Mm-hmm.
Yeah, so it's a spectrum and it's relatively complex. It's not a, and so we use the word non-fungible because there is no better word, really. They can't substitute for each other. That's what this means. And a couple of years ago, we had a spike in the gas price. Oh, sorry, a year and 2 months ago, we had a spike in the gas price of Ether because of crypto kitties, which were just these little pictures that were kind of an interesting genetic algorithm, so they could mate and they would have the characteristics of the two would fall through to the child and so forth. And the most expensive one, I think, sold for $115,000. And there are claims that some of them have sold for more, but I haven't really seen those verified. In fact, most of them traded for $100 or less, or about there. Plenty of them traded for in this sort of $200-300 range, and they were fun. They were just a cool, interesting thing. Where's the?
By the way, as they went through crypto winter, the price has collapsed.
I'm sure the prices collapsed. Of course, the prices collapsed. What a shock! Let me just give you a little overview of a couple of things. Here is a space station that was built by a gamer inside of a game. It's a digital game. And he built that space station over months and months and months and sold it for $330,000 to somebody who wanted it ready-made.
Mm.
So there is in fact about a $15 billion a year market in digital goods. These are called. They're also called virtual junk. Vunk is another word for these things. And there are many of these collectibles now that have imitated. That have imitated the kitties, and what are they? Well, the idea is it's kind of a unique picture, and it's got a unique token to it, so that if even somebody copies that picture, can't sell it as that thing. They have to sell it. It's a copy. Let's call it. It's a ripoff, right? It's a counterfeit. You could easily make one. You just cut and paste this image and put it into a different token, but it's not that one. It doesn't have the provenance. It doesn't have the specialness of whatever, so it may not be worth anything. Some of these things have sold for quite a bit. Mostly they sell in terms of Ether. So in terms of dollars, a year ago, those things might have cost, what cost $2,000 a year ago now is only worth, $150 because of the drop in the price of Ether, not because, and it may be still worth the same number of Ether. Here's one for $40,000, the Homer one. Again, that was at a time when Ether was pretty high, so the $40,000 is just relative to the price of Ether. And here's an interesting one. There's a group that not only did the kitties, but another group made hats for the kitties. And the hat is a non-fungible token, and you buy the hat for how much, and you can put it on the kitty. And then the kitty owns the hat.
Mm-hmm.
It's the kitty's hat. So then if you sell that token to somebody, the hat comes with the kitty. They're now bound. The two tokens have a relationship and they're bound. You can't separate the hat anymore from the kitty. There were many little items of clothing that came out for the various hats, for the various kitties, all of which are absolutely worthless at this point, but there were many non-fungible tokens. And last year for the World Cup, there was a betting token for the World Cup. And again, this was cool because it was a bet. It had a payoff based on the outcome of the World Cup. And you could easily trade that token in the market. And there weren't that many. There were only so many. And so they had some value, and they had some of them peaked, and some of them had, crashed and burned. But obviously the one that was with the winning team did very well, and the investors, and paid out well for the investors. So there are a lot of uses for these, and right now it's actually a little quiet. We're using something called ERC 721, which is a smart contract for these things. But I'm predicting that this year you'll see some big gaming companies, possibly some of the gambling companies or some other entertainment companies, basically. There'll be another, you can think of it like Pokemon, right? Pokemon is like this, it turns into a craze. And I predict another craze, and I predict it will come from Sony or EA or some of these big companies, they'll put a lot of marketing into it, and you'll be able to collect these things. We are working on adding these 721s into the Pillar wallet. I think we'll have them next month.
This week.
We'll have them this week, and they'll release this week, and you'll be able to save your collectible tokens in your Pillar wallet. There are lots of these things, and here's one. This is an AI painting made by an AI. It's called a generative and adversarial network, where the painter makes paintings, and then the judger decides whether it's any good or not, and mostly says no, and so the painter keeps painting, and the judge keeps saying no, and the painter keeps painting, and the judge keeps saying, and then eventually the judge says, yeah, sure, that's a painting. Like after 270 billion calculations or iterations or whatever. And then that's the painting that results. And this was sold on a digital collectible marketplace called Super Rare, and you can see many things there. And keep in mind, you could just cut and paste this and make a new one, but everyone will know that that's not the original, because we can identify that one by its membership in a certain smart contract. So you could rip it off, but you'd need a different smart contract to do it. You'd have to convince people that that smart contract was the one. In the same way, by the way, you could make a cryptocurrency called ETH right now, have its own smart contract, and tell people this is real Ether. It's worth $130 right now, so buy that. And it's just a separate contract, and it's just a rip-off. And you can't. There's nothing that prevents that. I'm working on a standard for token names so that all names are registered and can't be duplicated. But right now, you can easily duplicate it. So you have to make sure that people understand the provenance. This is the real token that has that image, and no other token does. Here's one where a guy just went to the Louvre website and took out Singer Sargent's painting and banged it into a token, and it had some history as it trades and so forth. It's a ridiculous idea, but it had actually traded for some amount of money. And then there's some cool games. This is called Crypto Against Humanity, and it uses tokens. It uses non fungible tokens to, as units of value in the system. There are marketplaces that do this. There are services that will put your CryptoKitty onto a whatever, so forth. So it's becoming an ecosystem, right? It's evolving into an interesting ecosystem. We really haven't seen a craze in the last year, but I predict the craze this year. We'll see. So that's the ERC 721. There will be, of course, other blockchains and other kinds of systems that will have non-fungible tokens. And fungible tokens are going to be here with us for a long time. And they have these various characteristics. So you can program them, and they can expire, they can double, they can breed, there's lots of things they could possibly do. It's a smart contract. So there's a guy who tracks this. He's got the Not So Fungible Weekly Edition, and he's called Brian Flynn. You'll find him on medium.com. He publishes every week. That's non-fungibles. Oh, this is another point. Did you know there are no Bitcoins? If you have 5 Bitcoins, you don't have 5 Bitcoins. You have 5 Bitcoin. It's a number in the ledger. So if you have 4.9 Bitcoin versus 5 Bitcoin, that's just this much off. There's no coins. People talk about it as though there were whole units, but the whole units don't matter at all. So a tenth of a Bitcoin, it's still just every bit as viable and reasonable as a Bitcoin. In fact, if you think about it, there's really only one Bitcoin in the whole world, and we all own 1/21 millionth of them eventually. But it doesn't matter. So it's not a discrete unit. It's like milk. There's no, I got a milk here. It's not one milk. It's I have some milk. I have some Bitcoin, not some Bitcoins. It's my little semantic talk. And then there's skin in the game coins, which are fun. So let's talk about skin in the game coins. Skin in the game coins use game theory to create what we call incentive schemes. This is called mechanism design. This is a formal area of study. You can get a PhD in mechanism design. This applies to voting systems, it applies to pricing, it applies to bidding systems and many others, where you have a set of rules that you hope encourages virtuous behavior. And you can start with a token that has no value at all, is worthless, and say these are the rules by which we create value in the system, and anybody who does anything bad gets penalized. And the first one of those that we can all name, that we all know, is Bitcoin. Bitcoin is such a thing. It has no value at all, but you can make them, and you can do certain things with them. You can play the game, and if you play the game according to the rules, you'll get rewarded with coins. There's no real negative score here. There's only positive. You can get coins or not get coins. There's no really taking away coins, right? It's a design of a mechanism that's designed to encourage people to protect the security of the blockchain, and it worked. It got in the first 6 months of that blockchain, almost anybody could have attacked it for not very much money. But the game mechanics spiraled it up and up and up, so that after a couple of years, it was very expensive it was kind of prohibitively expensive to play against the game and break it. And now, of course, it's extremely prohibitively expensive. It would cost billions of dollars to break the Bitcoin blockchain, and then you would have nothing because you would make them all worthless. And so it would be a waste of several $billions, so nobody's going to do that. So that's a game mechanic that has worked very well. There are plenty of other examples in the real world. But what we have now with tokens are these things called skin in the game coins. And I will run you through a few examples of that. So the best way to explain skin in the game coins, the best way I can do it is just to mention something like TripAdvisor. TripAdvisor is full of fake reviews, right? Something like 70% of all reviews are fake, and it's very common to put bad reviews on your competitor's service or product. And then 60% of something like, I forget if it's 40 or 60% of all reviews on Amazon are just fake. There's people and algorithms that just do this, bang out bad reviews or good reviews all day. And so it's become a kind of a cottage industry, right? So how can we avoid that? How can we even think about preventing fake news, whatever that is? I happen to think all news is fake news, but that's a separate story. If you wanted to, so use the example of TripAdvisor, where you break down hotels into categories. So it's easy to put together a list of the 5-star luxury hotels in London, for example. There might be 20 of those, I don't know. But it'd be a little harder to say, well, what are the good value business hotels for London? Well, the people who know that are the people who stay there. The people who use the travelers, they might not live here, but they might use these all the time. I'm staying in hotels in New York City every day. I could tell you a lot about many of the hotels, and I rate them. And so if we created a game and an economy around this, the way we would do it is we would say, all right, here's your, say, top 10 reasonably priced, mid-priced business hotels in London. Okay, and there are 10. So we've all come together as a community and we voted, and the top 10 are in this list. Now, a new company, a new hotel, an existing hotel or a new hotel says, well, we want to be on that list. Great. Well, we all have these tokens that power this community. So you're going to have to pay 1,000 tokens to put up your hotel for consideration. So you pay 1,000 tokens to put your hotel up for consideration. Now the community votes, and the way you vote is you cast 100 tokens. It costs 100 tokens per vote. You can even vote 10 times if you want. It's going to cost 100 tokens for every vote, right? So now we've accumulated a pot of tokens from all the voters, right? And now we will find out one wins and one doesn't. If the answer is yes, then that hotel goes into the list at, let's say, some position, and the lowest one goes out. Goodbye. right? So now we have the top 10 and you're in if the answer is yes. And if the answer is yes, then the pot of money is split according to the votes cast evenly by the winner, by the group, the people who cast the winning votes. And that means the losers have paid their money, they've lost their ante, if this is appropriate name, and the 1,000 from the hotel gets spread out among all the voters who won. And if the answer is no, it shouldn't be on the list, it doesn't get added to the list, and the pot gets split among the people who voted no. Now that means it's going to cost you money to go against the majority. That's all it means, right? It's going to cost you money. So if you're always in the minority, you're always losing money. It's going to be costing you. And as this game becomes more popular, the tokens rise in value. So you could just buy some of these tokens, hold on to them, they may rise in value, just as Bitcoin has. So in this mechanic, as the thing becomes more of an economy, there are natural buyers, there are speculators, there are people trying to put together different trading plans, but all of it will cost you money to be on the losing side. And that's different because now your review farm is spending every time they put out a fake review that doesn't work, it's costing them money. So that's a pretty good mechanic, and we're starting to apply that in many areas. And we're also seeing that many of the groups that this became very popular about a year ago, and there were a lot of medium.com articles about skin in the game coins. We're also saying it's harder than you think, and that getting these things started is difficult. So there were several ICOs based on these for various things, everything from insurance to betting, prediction markets, and so forth. And it's harder than we thought, and not very many have emerged. One really interesting one is called Civil. That is for journalism. So your team, it's based on what's called a newsroom. Your newsroom puts out news, and every time it puts out news, it stakes. You put out some tokens with your news article or whatever, and then as the community votes if this is valuable or not. If it's not, you lose your stake. If it is, you participate in the winning share. And it's a very interesting group. They've raised enough money to bring on some fairly serious newsrooms. People are publishing interesting news. And it's still at the beginning stage. It's still a pretty uphill road. But their goal is to change the news model so that the consumers pay to consume the news and then they vote. Right? You read it and then you vote. And if you vote that this is crap and you are in the majority, you'll get paid to have read that. You'll get money back for having read that and voted. And if you pay and you vote that this is worthy or this is good or this is true, whatever that means, you'll get paid for that if there are people on the other side of the trade who lose, right? So that's pretty interesting. You got to admit, right? We've got new things like quadratic voting and other mechanisms coming on board now that could use a native token to grow an economy.
So why would somebody actually publish the news if they're publishing the fake news on such platforms?
Because it's such a subjective.
It's a voting thing. It's a voting thing. So it's subjective, but if 2,000 people vote, the rule is that the majority carries. So one of the things about this and about token systems in general, and this gets to a really interesting paper by a researcher named Robin Hansen called Futarchy, is that it gives whistleblowers a chance to anonymously bet with inside information and make money if they do. And this paper called Futarchy, which you can look up by Robin Hansen, says that this is how we should run companies. So if we say that we're going to vote on CEOs, and we've got 5 CEOs, we could use a voting system where it costs money to vote, and people who have then inside information can try to arbitrage that, and without giving away who they are, put their money where their mouth is with skin in the game and say, that's a bad thing, I'll bet against that. And that will help bring information out that was previously buried, previously not able to come to light, because it might be very costly to be a whistleblower. It might have an impact on your career. If a company is planning a merger, for example, a merger is a perfect example because 90% of mergers do not work. 90% of mergers are a complete waste of time. So if someone has inside information about why that might be good or bad, person could vote put his money where his mouth is, and possibly make some money on that inside information, but provide an overall benefit to everyone, because that information normally wouldn't come out. So these tokenized mechanics are starting to become pretty interesting, and there are a handful of people now who are mechanism designers professionally, and will work with clients to design these virtuous systems where it pays to be right and costs you money to be wrong. Now, right and wrong is subjective, for sure. However, a majority rule approach using crowd wisdom may be one of the best ways to sort of get to the bottom of things. You can't imagine very many there are no perfect schemes for determining what the truth is, that's for sure. So this is one scheme that involves crowd voting and crowd economics that you might have to tweak these, right? We might find that later this was good, but here's a better mechanism, and we're getting, and if things grow and they catch on, then you might find that making big, important decisions for a country, for a company, even for a family, could involve people who are, a good example would be scientific experiments. Should we fund this experiment? We have $1 billion to give away to fund experiments. How do we do that today? Pretty randomly, by people who are tall and good looking, and there's lots of biases in the process, and people have a good story and so forth, and much of the research dollars are wasted. But instead we could have betting markets that say, well, this isn't worth doing, this is worth doing, see who the insiders are who might have a good idea, a better educated guess on whether this would be worth funding. That's going to be a much better system than the highly biased and personal system that we use today. So in fact, not being perfect is not the reason to do this. Being better than the crap we use today, than the lousy standards we have for deciding who's in and who's out, or what's up and what's down, or what's truth and what's false. There are going to be a lot of systems that are better than that. And that's pretty exciting. Did you have a question?
I think it was answered.
Okay.
Can we maybe just briefly talk about other applications of this mechanism? So maybe credit guarantors.
Credit scoring.
Yeah.
Credit worthiness. Sure.
What about project completion time? So you've got a big construction project and the workers on the ground.
Yes,
know
they might have a
it's
much
running
better.
right.
That's a great example. Yeah. So skin in the game coins, and it's going to cost you something. And that's the idea. Because if you're wrong, you'll lose. So you can't be wrong too many times in a row in a game like this, and you're not going to want to keep playing. The idea is to make the threshold of the economic bet so that an evil actor won't keep doing it. Once they lose enough, they're out. It's not, you can't make money by spending in this category to game it, right? So you have to you have to adjust the economics so that somebody can't overwhelm it, right? And that would be a perfect example. Any kind of project completion, company decisions. The Futarchy paper is, if you're interested, please look up Futarchy by Robin Hanson. It's fascinating. And in all cases, if you're wrong, you lose money. And that's the idea.
Danger can become mass hysteria.
Well, we already have that today. We're pretty good at mass hysteria already, right? We have that in Facebook right now, right? So we got pretty well worked out. So if we could have less hysteria by making it expensive to be, hysterical, maybe that will help. It's very early days on mechanism.